Hello, everyone, and welcome to Girard's Monthly Market Update. I'm Senior Vice President and Wealth Advisor Jim Jacobson, and joining us again today is Chief Investment Officer Tim Chubb. Thank you for joining. Today, we're going to be discussing recent market events, where things stand in terms of relative valuations and opportunities, and then we'll take a brief look at the back half of 2020. So to begin with, we find that the stock indexes have rebounded significantly off the March lows, and as we discussed last month, these market forces seem to be pricing in a rosier picture than what the economic reality is currently showing. Tim, give us an idea what sectors or specific areas of the market have been leading this recent charge as we watch the indexes attempt to break back into positive territory for this year.
Yeah, good to see you, Jim. It really has been an unusual year. I mean, if you kind of take a step back and look at the last 18 months, we had a year where we came, erased all gains within, December of 2018. We saw a phenomenal 2019. 2020 so far has obviously been a challenging year, seeing 30% decline in the S&P 500 to a 30% or 40% rise in the S&P 500. And we've seen multiple leaders within the market sort of under the surface really driving the market during that period of time. And so, as we discussed since we were together last, there has really been an interesting time where we've lacked a lot of breadth within the market, meaning very few companies were driving it higher coming out of those March lows. A lot of the distressed cyclical businesses, which have been leading recently, as we've seen sort of a reflection higher, or inflection higher, I should say, to the purchasing managers in the indices. They've really been acting in correlation, while these distressed cyclical stocks have been performing quite well. So I think you can really break down companies in the market in three buckets. One has been businesses who saw demand being pulled forward. So demand that they might have seen in the third or fourth quarter, the second half of the year, like a grocery store chain, as a lot of Americans stockpiled food. Obviously, saw demand getting pulled forward. There are many businesses with lots of reoccurring revenue, like a software as a service business, that saw demand relatively unchanged because of just how sticky their customer base is and how high switching costs are. Then there's demand that's been delayed, and that would be something along the lines of getting a knee replacement. Those who couldn't get a knee replacement in April or May, well, most were definitely scheduling for June or July, and those who needed it for June or July are most definitely going to need to get their knees replaced nonetheless. And then the last was the demand destroyed. And so that's energy, that's airlines, that's casinos and hotels, where the demand that they would have seen in April and May just isn't going to come back. And so I guess as we take a step back, I think delayed demand and destroyed has been leading the market up. I think from a valuation perspective, those who have had demand unchanged or demand delayed look most attractive from an investment perspective. And that spans across all sectors. I really think you have to be selective with what you own in such an unusual and volatile market like we're in right now.
So that's an interesting take on demand forward and demand destruction and all points in between there. And it kind of makes me think of portfolio management. And when it comes to rebalancing, as we get closer to the midpoint of the year, we often rebalance our client portfolios based on market activity and sometimes based on a mid-year. And a lot of times I think clients try to time the market or rebalance in their minds based on some media headline or something like that, and where we encourage rebalancing to be done on a rules set type. And that's worked quite well for us over the years. So I know our investment committee meets every 2 weeks, and as much fun as it would be to try to time the sector rotations 26 times a year, the fact of the matter is that we rebalance with a set of guidelines, and that has served us quite well. So as we look back as we look forward, I should say, into the back half of 2020 now, and we look for the investment opportunities, one concern is that COVID-19 cases could resurge. I'm not saying they will, but there could be a resurgence. And while nobody wants a lockdown environment, if that does come, or if there's some kind of quasi-permanent change to work life, school life, social life, what scenarios would that possibly open up for meaningful market opportunities?
I think you make a great point. Of course, it's a lot of fun to try to be, a tactical investor. But, if you're a Girard, as you had mentioned, we really try to focus on making strategic asset allocation decisions where, we expect some trends from a macro perspective to persist for 12 to 18 months or even more as we look at full market cycles of 3 to 5 years. And, ultimately in this environment, despite it being such a horrible tragedy and as a result of COVID-19, I think we've seen, a really an unusual time where years worth of transformation, years worth of behavioral changes have happened in a matter of months. We've really accelerated some of these secular growth stories or themes, which will likely be a tailwind for the market moving forward in the next several years. I think one of those major themes is sort of this counter-urban theme, where we have 78 million millennials who are either entering looking to purchase their first home or maybe move into their forever home. I know it's hard to believe, the oldest millennials, and I'll put my hand up, were born after 1980. And as a result, they're ultimately entering some of their peak working years, their peak child raising years, and their peak filling their houses up with junk years. And I think as a result of COVID-19, obviously a lot of employers have been much more flexible and open to having employees work from home, work from wherever they'd like. And given where school systems are at within certain cities, with taxes being a lot higher in inner cities compared to the suburbs, we may see a lot of those millennials, and in particular, start to move out to the suburbs, just as the baby boomer generation has sort of moved into the cities to have that urban feel. And it's coming at a time where inventories are extremely low in the housing market, especially in the suburban areas. Obviously, interest rates are extremely low. And a lot of millennials work in the services business where, they maybe haven't been as impacted by some of the unfortunate aspects of the labor market recently. And so I think ultimately this and many other things, which I look forward to talking about, as I know you'll mention in our coming town hall meeting, I think are ultimately some interesting themes that we should be focused on as investors, as being accelerated by what's happened within the last 6 months.
Excellent update, Tim. Thank you for sharing your thoughts as we approach the middle of what has certainly been one of the most surprising and frankly interesting years in a long, long time. Now, looking forward, I do have an update for our audience today, and that is to let you know that we'll be hosting a town hall coming in mid-July, and we'll highlight things of where we stand in the middle of 2020, as well as discussing some investment themes that have been accelerated by this period of germs, so to speak, that has transformed history. I'm reminded of a great book from about 25 years ago called Guns, Germs, and Steel, and that took a historical look at major events that transformed world history. So as we look forward, it will be interesting to see where COVID-19 fits into that spectrum. For our town hall coming up, however, we'll stick with market themes, and we'll be focusing on what clients are asking most about, and that is what is coming up in the next year, 2 years, 3 years. So also, I encourage you to visit our website, which is meetgirard.com. That's meetgirard.com. And there you'll find links to our full suite of services, as well as to background information about our advisors in the field. So our goal is very straightforward. We want to help you succeed financially. When you succeed, we succeed, and together we move forward. So thank you for joining us today. Thank you, Tim, for your insight. We appreciate everybody's time, and we look forward to speaking with you again next month.